A one-bedroom condo in Toronto costs $630,000 to buy. Renting the same unit costs $2,300 a month. One of those options builds equity. The other might actually make you richer. Here's the honest math. Most people assume buying is always better than renting. You're building equity. You're paying your own mortgage instead of someone else's. That logic made sense when home prices went up every year. In 2026, it doesn't. Let's run the numbers on a real scenario. A one-bedroom condo in Toronto. Purchase price $630,000. 20% down payment means $126,000 cash up front. That leaves a mortgage of $504,000. At 4.5% over 25 years, your monthly payment is roughly $2,770. Add condo fees of roughly $600 per month. Property tax of roughly $350 per month. Home insurance at roughly $100 per month. Maintenance reserve of roughly $100 per month. Total monthly cost of owning this condo is roughly $3,920. Now, the rental option. The same one-bedroom condo rents for $2,300 per month. That's $1,620 less per month than owning. $1,620 every single month that stays in your pocket. But wait, you also had a $126,000 down payment. If you rent instead of buy, that money stays invested. At a conservative 7% annual return over 25 years, that $126,000 grows to roughly $684,000. Now, add the monthly savings. $1,620 invested every month at 7% for 25 years compounds to roughly $1.3 million. Total wealth from the rent and invest strategy after 25 years. Roughly $1.98 million in investments. Total wealth from the buy strategy after 25 years. A paid-off condo currently worth $630,000. Even if it appreciates at 3% per year for 25 years, it would be worth roughly $1.3 million. The rent and invest strategy wins by roughly $700,000 in this scenario. Now, before you close this video, let me explain why it's not that simple. The buy scenario gives you a guaranteed place to live that nobody can take away. No landlord selling the unit. No renoviction. No above guideline rent increase. That stability has real value that doesn't show up on a spreadsheet. The buy scenario also forces savings. Every mortgage payment builds equity whether you feel like saving that month or not. The rent and invest strategy only works if you actually invest the difference. Most people don't. They spend it. And if you spend the $1,600 monthly savings instead of investing it, the math completely reverses. The investment returns are not guaranteed. 7% is a long-term historical average for a diversified portfolio, but the market can drop 30% in a single year. If you need that money during a downturn, you sell at a loss. Your mortgage, on the other hand, is a fixed obligation with a predictable outcome. Taxes change the math too. In Canada, your primary residence is exempt from capital gains tax. Your investment gains are not. The recent change to capital gains inclusion rates means gains above $250,000 are now taxed at a 66.7% inclusion rate. That takes a significant bite out of the investment returns. And then there's rent increases. Ontario's guideline rent increase for 2026 is 2.1%. But that only applies to units built before November 2018. Newer buildings have no rent control. Landlords in newer buildings can raise rent by any amount at lease renewal. A $2,300 rent today could be $2,800 in 3 years and $3,500 in 5. The investment math changes dramatically when your rent keeps climbing, but your mortgage payment stays fixed. So when does buying actually win? Buying wins when you plan to stay for at least 7 to 10 years. The transaction costs of buying, including land transfer tax, legal fees, inspection, and closing costs, can exceed $30,000 to $40,000 in Toronto. You need several years of appreciation just to break even on those costs. Buying wins when you're in a market with strong price growth. In Saskatchewan, where prices are climbing 5 to 8% per year, owning builds equity fast. In Ontario, where prices are down 6.5% year-over-year, owning is currently destroying equity. Buying wins when you lack the discipline to invest the difference. If you know yourself and you know the savings would get spent, then the forced savings of a mortgage is the better strategy for wealth building. And buying wins when interest rates are significantly lower than investment returns. At 2% mortgage rates, buying was almost always better. At 4.5% with uncertain markets, the calculation is much closer. When does renting win? Renting wins when you're in an expensive market with flat or declining prices. Toronto and Vancouver right now. Renting wins when you have investment discipline and consistently put money into the market. Renting wins when you value flexibility and might move cities within 5 years. And renting wins when the monthly cost gap between owning and renting is large enough that the invested difference compounds meaningfully. The honest answer for most Canadians in 2026 is that neither option is universally better. It depends on your city. It depends on your income. It depends on your discipline. And it depends on how long you plan to stay. Run the numbers for your specific situation before making the decision. Don't let anyone tell you buying is always better. And don't let anyone tell you renting is throwing money away. Both can build wealth. Both can destroy it. The math is what matters. Are you renting or buying right now, and why? Drop your situation in the comments.